Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. HSBC shares drop in Hong Kong after reporting a miss on profits, while UBS sees an improved outlook and an earnings beat. We will hear from the UBS CEO Sergio Ermotti in just a moment. Kering says US tariffs are manageable, but the Gucci maker still saw a tumble in sales. Hermes is the next luxury brand to report. And global equities and futures edge higher as China's trade negotiator says there's agreement on extending the US tariff truce, but the US says it's too early to say.
Wednesday morning, good morning. The next 3 days are going to be absolutely pivotal for these markets. Today really kicks off that story. We've got a series of banks reporting numbers. We'll get to UBS in just a second. We've got Santander, we've got CaixaBank, we've got HSBC, all to fold into the mix as well. You're going to be talking about Meta later on. You're going to be talking about Microsoft. And, of course, it is Fed Day. Overarching all of this is the trade narrative that we're watching so carefully. It is reaching into every single one of these stories and having an impact upon it. UBS is absolutely no exception this morning. The numbers dropping a little bit earlier on. Second quarter pre-tax profit, that has exceeded expectations. Net income also beating up 2.4 at $2.4 billion versus $2.2 billion, the estimate there. There's a bunch of technical factors in there relating to the wind down of Credit Suisse, also some provisioning there. What is interesting, though, is looking forward, what we're hearing is that actually, with some certainty, clients are starting to transact a little bit more. And it was those earnings that Francine Lacroix kicked off in her conversation with Sergio Ermotti a few minutes ago.
If I look at the overall profitability, particularly when looking at the core underlying profits being up 25% year on year, with wealth management businesses in every region growing on a PBT basis, double digit, very strong, and I see good inflows in our alternative business in asset management, reaching 300 billion of assets. In markets, we delivered the second best quarter on record. So I think that across the board in Switzerland, we continue to be a strong partner to our clients, with 40 billion of credits or renewed credits. So across the board, making good progress on the integration. Big milestones was achieved. 400,000 clients were migrated in Switzerland in a smooth way. We are now working on delivering the second wave in the third quarter. And in non-core and legacy assets, we are making good progress in taking down cost. And I'm very pleased.
So even ahead of expectations in terms of integration?
Mm-hmm. No, we are online. We are on track. I mean, the integration, I think the next, we already achieved 9 billion of cost savings out of the 13. So we believe between now and year end, we're going to achieve another billion or so, and then 3 billion are going to come in 2026 as we basically shut down all the legacy systems, and we also complete all the logistical migrations.
The relationship between UBS and Switzerland looks from the outside to be at rock bottom. Do you need Switzerland?
I think that we have a very strong and solid relationship with our clients and the broader Swiss business community and client space. We serve more than 2.5 million clients, probably even higher, 200,000 SMEs. So we have a very solid and embedded relationship with the communities where we live and work in Switzerland. So I think that's I wouldn't really extrapolate some kind of issues to the broader Swiss. Switzerland, the vast majority of the people recognize our value, and we recognize the value Switzerland brings to us.
When you look at the market views, of course it's a big week for trade. I think we also have GDP a little bit later in the US, but how do you see it going forward?
Well, I mean, the good news is that now we have probably a higher degree of predictability on what the outcome of this tariff discussion will be. If we land at around 15% on average is a base case scenario, which in any case is something that needs to be digested. This is 6 times higher than what we had at the beginning of the year. This brings some kind of inflation. If you think from an exporter standpoint of view, if you are a Swiss or a European exporter, you are basically seeing your clients in the US have to pay 15% more because of tariffs, plus another 10 to 15% more because of FX. And this is a quite big change, so it remains to be seen what's happening in Europe in terms of economic effect, but also what is the consequences for inflation in the US, and this will then translate into potentially consequences for the monetary policies of central banks.
But Sergio, are clients saying, look, they're also worried that this is not it for tariffs, that they can always move back, so actually the uncertainty could remain? That's
a fair point. I think that's what investors and clients, corporate and institutional investors, private investors want to see is stability. First of all, we need to reach agreements, and then they need to see that there is a degree of predictability and stability in these agreements. There is a degree of news fatigue in the market, so people want to be able to act with certainty.
A little bit of fatigue, certainly feeling that. UBS's CEO, of course, Sergio Ermotti, in conversation with Bloomberg's Francine Lacroix over in Zurich. It is a busy morning for banks. We've got a series of big banks around the world reporting numbers. HSBC, we're going to be talking to Santander very shortly. We've got CaixaBank coming up, Kriti. HSBC looks like quite a decent miss. Looks like it's been hit by some provisioning. Looks like there's a cost rise in there that's hitting those numbers as well. The market didn't like that in Hong Kong.
Market didn't like that in Hong Kong. You've got Santander and Caixa, as you mentioned as well. Santander, I thought, was interesting. They came in, they're meeting in line with estimates. It's not a massive beat. It's not a massive miss either. To me, they're rarely talking about the tariff hit. They're talking about their exposure in South America. And CaixaBank, you're seeing similar, starting to see worries where UBS is saying maybe this is a little bit of certainty, maybe a little bit of clarity, a little bit of we can proceed with a little bit more of understanding of how the macroeconomic environment is going to look. Not everyone thinks that way in terms of the banking sector, but what the common thread is across the board is buybacks continue for every bank that's reporting this morning.
Yeah, we are seeing some that is a theme coming through in the bank earnings. I feel from the mega sort of banking space, it's HSBC versus UBS this morning, isn't it? We've seen that in Hong Kong already in the HSBC share price reaction. To your point, some of the numbers coming in lower than expected. Impairments over at BoCom coming in higher than had been anticipated, but that hasn't stopped a $3 billion share buyback. So yes, there's both of those sort of pushes and pulls. But HSBC on the sort of negative side of things, and UBS on the much more positive side. And UBS, what stood out to me was talking about the high level of readiness that clients have for a pickup in some of the investment banking activity that has not been there in the first 2 quarters. Because in the first 2 quarters, it feels like banks benefited on the trading side, the market side. That's all great, but people don't do transactions and deals in that environment.
So they're waiting for certainty. Does that certainty now come? The wealth division actually underperformed a little bit, and you wonder whether or not that is related to what we've seen in the first 6 months of the year. Now, the first 6 months of the year have been really volatile, so that's great if you're trading. So we're going to talk to Man Group very shortly, and we'll figure out exactly what the trading picture looks like. But if you're a wealth manager, that's a much more difficult environment in which to navigate, and you wonder with a bit of certainty whether or not that starts to pick up. My question is, do we get that certainty? You look at the trade picture between the European Union and the EU. We'll come on to that in a moment. Are we there? Have we got some certainty? We've got a little bit, but not that much.
Yeah, let's talk about some of the other earnings stories we've got coming through, because some of these referencing the trading environment, the tariff environment, rather. And let's start with the luxury sector. I mean, things looking pretty gloomy in this space. Hermes is different. Set Hermes aside. They seem to be doing something different. But Kering, Gucci sales falling 25%. Even Kering, the group, had a big drop in sales in the second quarter. Some of that was in line with estimates, though, so not to overstate the surprise involved there. And they are saying that the tariff picture is totally manageable. That's the message out of Kering. Not necessarily quite so luxury, but L'Oreal in the consumer space. Weak Asia, weak Europe, but North America looking strong. But again, the overall sense of a little bit of disappointment coming through in some of these earnings from luxury and consumer-facing companies.
So I think the line from Hermes, I think, is the most interesting one. Kering saying we can handle it. what Hermes is saying is we await clarification on what the 15% tariffs
are they looking for an exemption
mean.
for Birkin bags?
Well, maybe. LVMH, I think everybody's looking for an exemption on champagne. The FT was reporting that this morning, that they're looking for some sort of carve-out. If Airbus can have a carve-out, why can't champagne have a carve-out? Seems to be the strategy.
Well, Eric Lombard over at the French minister actually made those comments on radio this morning, on French radio this morning, so they are actually negotiating those carve-outs as it is. Mercedes was another one that saw a massive hit, and they're really citing the tariff story and the over-competition question from China as well. We'll see if that changes as well.
And Adidas also stood out to me as one that, you know, some of the numbers coming in better than expected, but still not able to upgrade guidance, and some of the guidance looking a little weak and not able to upgrade because of the uncertainty around tariffs, and that seems to be where their head's at right now.
There seems to be this view. There was a nice line in one of the notes that I read this morning talking about basically this is back of the envelope stuff from Trump at the moment in terms of the trade deals that are being done, and the details just aren't there at the moment. And this is going to mean that actually, while we think we've got certainty, the uncertainty is actually going to persist longer than we anticipate, because it's going to take a long time to get all of this done. And just to come back, there's so many elements within this European deal that we don't know about. If you're a corporate this morning and you're trying to put a number on it, I think it's really hard. I think the auto sector probably has more clarity than it thought it would get, but the luxury sector looks like it is woefully disappointed in terms of what it is anticipating. They simply don't know, and I think Hermes saying we await clarification tells you everything you need to know.
But this is for the first time, and it feels like these earnings that we're getting yesterday, today, probably likely in the next couple of days as well, is an actual sea change from what we've seen in the last couple of quarters, which has been we can navigate this. We're okay. Yes, there's uncertainty, but we're still good. We're keeping our buybacks. We're keeping our guidance, et cetera. This is the first time we're actually seeing numbers put to the tariff impact. We're seeing the guidance pull back in some places, not just here, but around the world. Yeah,
and it's interesting to the point about lack of detail. A phrase being used in Singapore at a business event there just over the last couple of days is napkin deals. That these are
that was the line that I heard. Back of the envelope.
Exactly. Napkin deals. That's as much detail as you have, what you could scribble on a napkin, which I thought was interesting. And we lack detail around Europe. We also really lack detail about what's going on and the state of the conversations between China and the US. You'll remember we sent Oliver Crook to Stockholm, camped out outside that venue, and the Chinese are saying that there's been an extension that they've agreed, but the US has said it's premature to say that, and President Trump has still got some details to look at. So there's a lack of clarity perhaps there.
Yeah, Scott Bethan's basically said we're going to let the president decide as to whether or not there is going to be an extension, and that's amazing, considering that we thought we had something. But it's also amazing that nothing has been agreed. That is the real takeaway for me here. There's been actually very little progress, other than the fact that maybe we're going to have an extension.
And it says something that just that positive mood music of things not deteriorating is enough to write about. Yeah.
Anyway, we've got some great interviews coming up. We're going to be talking about all of this throughout the show. Antoine Forterre is going to be joining the Man Group CFO. That group has just posted numbers. Look like we've seen some decent inflows coming through. Jose Garcia-Cantera, Santander CFO, and Gonzalo Gortazar, CaixaBank's CEO, are going to be joining us a little bit later. We'll talk about what the Spanish banking story looks like, what the M&A picture looks like there, what's happening in the Spanish economy. And Eamon Eziat, CapGemini's CEO, will be joining us a little bit later on in the show as well, Kriti. But today is the start of a really kind of big run of events over the next few days that could be really kind of pivotal for the next few months in terms of setting the scene.
Arguably the most important data week of the year, frankly, on both sides of the Atlantic. Let's take you through what some of those data points are for today. Of course, the big event is going to be the Fed decision and some of those tech earnings after the bell. But before we get there, at 10 a.m. UK time, we have Euro area second quarter GDP. We have U.S. second quarter GDP. Do we start to see some sort of tariff read-through show up in those numbers? And then, of course, the Bank of Canada rate decision as well. Remember, we are still waiting on a trade agreement, or at least a tariff agreement, or even a tariff announcement when it comes to Canada and Mexico. That deadline only 2 days away. So that's going to be something that we'll see where the commentary lies when it comes to Canada. But then again, as we talked about, Fed, arguably Microsoft are the two big hitters later today. Yeah, Meta and Microsoft in focus for the AI spend, the CapEx spend. Of course, we saw that from Alphabet. That was a big focus, wasn't it? And of course, the Fed meeting as well. Let's tell you what else is coming up on the programme. We'll stay across updates on tsunami warnings that have been issued across the Pacific after a powerful earthquake in Russia's Far East. An 8.8 magnitude quake hit just off the Kamchatka Peninsula in Russia. So we'll certainly keep across that. We've seen tsunami warnings from North California
to New Zealand. So far, there are lots of aftershocks, but so far, any waves that have been seen have been small, but we'll keep an eye on what is happening there. Plus, Adidas, in terms of the earnings stories then, Adidas says that customers are snapping up its retro sneakers, but tariff uncertainty is holding back outlook upgrades. We'll check on that stock at the open. Up next, we'll get to that conversation around the hedge fund sector. We'll talk to Man Group's CFO, Antoine Forterra, will be with us to talk shortly on the programme. If you have any questions, if you want to get involved in any of these conversations around this desk, IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
"16 minutes past the hour. Welcome back. You are watching the opening trade. There's an awful lot of corporate news that we need to be folding in to the story this morning. Let's talk about one of the big names that is out with figures first thing, and that is Man Group, the giant hedge fund, listed hedge fund. Its assets under management certainly looks like they have beaten, that number looks like it has beaten estimates. Net inflows significantly ahead of where I think a lot of people had the number at 17.6 billion. Why was that? Why are we getting such a high number in terms of the inflows? Well, let's try and find out. Antoine Forterra is the Chief Financial Officer, I think now Chief Operating Officer as well, over at Man Group. Good morning. Nice to see you.
Good morning, Guy. Thank you. Thank you for having us.
Let's talk about the inflow number. That looks a little bit distant to what I was anticipating. Can you just give us a bit of colour in terms of what the inflow picture has looked like?
Very happy to. So the first half shows the resilience of our business model and the relevance of our strategy. In what was a tough period for some of our strategies as well, let's be clear. Yep. We had $17.6 billion of net inflows. This is a record half for us. 193 billion of AUM, record yep. AUM. And we've seen great demand for some of our long-only systematic strategies, from our credit strategies yep. Across the board, as clients kind of grapple with the forces in the market and want sort of well-crafted, curated solutions that we can deliver.
Just in terms of that inflow number, though, yeah. Was that is that across the board? Is that one particular name that's come through?
So one large mandate win, right. A $13 billion systematic equity mandate from a European institution looking at sort of global equities, and we crafted a solution for them. But aside from that, we saw flows, as I mentioned, in kind of broadly equities, systematic, broadly credit, and other kind of solutions that we offer. So kind of wide range of inflows demonstrating the kind of breadth of what we do and the validity of a strategy to continue to build that breadth.
Okay. All right. So that's and good morning to you, Antoine. Let me ask you. You mentioned in passing there it had been tough for some of yeah. your strategies. So let me just pick up on that, yeah. If you don't mind. Where have you seen the volatility in markets not playing well? Because for some of your strategies that must have delivered well, I imagine.
So we have an important strategy for us called trend following, which we've pioneered over 30 years, and this has been one of the toughest years on record for the strategy overall. Well documented as to why the kind of volatility and the flip-flopping in markets that we've seen are really not conducive to performance in those strategies. But as I said, irrespective of that sort of pocket of poor performance, we have record AUM, record flows, and one figure which I think is also important to flag, we have $67 million of performance fees in the business, which come from our multi-strat and long-only offering, none from trend following. And again, it shows how diverse the earnings and revenue potential of the business is.
Can I ask you about the direct lending side of the business? That's something that you've been leaning into recently. How has that performed?
It's performed well. The performance is good. It's performing according to expectations. What we've seen in that space is continue to raise some capital. So committed capital for kind of private business is $4.9 billion. The deployment environment has been softer. It started the year well until February, and then the volatility that we talked about just now impacted really the M&A market in the US, and through that the deployment of the activities. But it's a strategy that we firmly believe in, and our clients appreciate. We announced kind of an acquisition a few weeks ago of a business called Bardin Hill, which will complement that direct lending offering by focusing on kind of US opportunistic credit as well as loans. So we're building actively our broad credit offering.
Antoine, I want to take a 30,000-foot view of all of this. You're in the volatility business. So far, in the last couple of months, it feels like, to use Sergio Ermotti's term, there's market fatigue right now. There's news fatigue in these markets. In a low volatility environment, if that's how the rest of this market progresses, how does that help or hurt you?
So what we're seeing is a sort of tug of war between inflationary forces. Inflation is still not back to target levels, and you obviously tariffs coming in with possible impact there. And then deflationary forces with slowing economy perhaps in places. The question of what will AI do to kind of broad economy. And I think that's what's reflected in the markets today. Importantly for our business, you're right, we're in the volatility business, but we like those sort of uncertain environments in that it provides opportunities for clients to engage with us, look at diversifying content, defensive alpha, find liquid solutions that help kind of protect portfolios in periods where there's uncertainty and valuations might be high in places, and that's what we're here for, and that's what we see in the flows we printed this morning.
How does that show up in terms of kind of higher margin products versus lower margin products? If it is that kind of defensive tone, as you say, is that an expensive tone to take?
No, so margin for us is really an output of the client demand. We have products at kind of hedge fund fees, as well as product that's very reasonably priced at scale. And it's all a function of how clients use us in their portfolios. Are we a kind of more niche, kind of crafted solution that might have kind of specific fees? Or are we a core component of a larger allocation, which comes with size and therefore more proportionate fees? What is important for us, for our staff, for our shareholders, is ultimately the profitability of the business that we run and the growth that we deliver.
Give us an outlook. What's the rest of the year look like? Given all of what you've just said, what does the rest of the year look like? Are we going to continue to see the kind of markets we're seeing at the moment? Like, what do you think of equities at these kinds of levels? What do you like? What do you not like? Sergio Ermotti was talking to us a little bit earlier on. He's talking about maybe a return of certainty. Like, do you see a return of certainty? And if so, what impact does that have in terms of what clients do in the second half?
We entered the half with strong momentum and perhaps a return of certainty, in which case what you would see is kind of valuation normalizing. You would see trends, and that would be good for quite a lot of our content.
Valuations normalizing?
You could especially expect valuation normalizing.
What does that mean? Like the S&P's average multiple is 18. We're at 22. Do you think valuations are normal at the moment?
They're on the rich side, but if you look under the hood, there's certain stocks that drive this.
Tech stocks.
Tech stocks, exactly.
Yeah.
Other sectors, including some that we're in, including some of the banks that are reporting, still possibly have room to grow. But I think what's important is as people kind of grasp what could be a pivotal week, and I think that's something you've reported on, you'd expect probably the agenda for the next few months, weeks to be set, and clients to look at how their portfolio allocations need to adapt.
Antoine, can I ask you about the sector and the hedge fund community in London? We seem to, obviously Man Group has a long history, hundreds of years of history here in the UK, but we seem to carry lots of stories about hedge funds moving to other parts of the world, in particular to the Middle East, to Abu Dhabi or Dubai, driven there or incentivised there by all kinds of different factors. Is the world of Mayfair changing a little bit? Is the London hedge fund community changing, or are these just sort of marginal developments?
So, if you'll allow me a little aside, we sit here above the Temple of Mithras, which was restored at great cost by Bloomberg. And Mithras was the divinity of kind of the pioneers of the empire, the fridge of the empires, 2,000 years ago. And what it tells you is that London, the city of London, was built in sort of fridge lands, which were intended to connect the empire with the rest. There was where you could cross the river, where you could access it by boats. And the city in London, by extension, is a city of pioneers, of innovators, a city of merchants, of adventurers. And that's the spirit that you have and that the current government is trying to instill in the market. And
low taxes in Dubai, not enough to offset that.
There's plenty of attraction.
Let's just be clear about that. It
was a wonderful story.
And you got a lot of attractive offers here. Now, we're a talent business,
Yes.
and we watch what happens as well with anticipation. And, we're a huge success story, export success story, happen to operate from here. But it's important that we also follow the talent. So we look at what happens here and in the Middle East, and we'll take stock. But at that time, we have no issue in attracting the talent that we need to run the business.
Is talent like what are you seeing in the talent front? Is the cost of talent going up at the moment? Is it reasonably stable? What's happening in terms of junior roles, AI? Kind of just in 30 seconds. You're the operating officer now. What are you looking at?
So we have a great culture. We have kind of record low attrition, sort of second best year for attrition, and lowest in 8 years.
Yep.
There is pockets of demand for specific tech talent, AI talent, or certain kind of investment talent, but we feel we compete in that space. The rest, the attractivity of London and other places remains, but we are an agile business. We look at where talent is and make sure that we can offer what they want.
All right, Antoine Forterre, Chief Financial Officer over at Man Group, walking us through those earnings numbers and how we're seeing a little bit of the world. As he was speaking, we did get this Rio Tinto headlines. Looks like they have an underlying profit miss when it comes to those estimates. We're going to see how that's received at the open, but at the moment, a pretty decent miss when it comes to Rio Tinto. Plenty of more earnings interviews and earnings coverage coming up. Stick with us. This is Bloomberg.
Welcome back. 30 minutes from the start of European equity trading for this Wednesday, the 30th of July. We have had plenty of earnings stories out this morning to factor in. Some of those from the banking sector, the luxury sector, also well represented, as are cars, consumer-facing products. It's a really busy week for those earnings stories, and this is the sum total of what we expect to see at the start of the equity trading session, a slightly lackluster response to all of those. I mean, you've got some will go up and some will go down, seems to be the conclusion.
And maybe they'll balance each other out, and that's maybe why we're going to see some low volatility in this market this morning. So yesterday was a really interesting session from a bond market point of view. Really big bid coming into the bond market as the market sought safety maybe ahead of the Fed. Maybe we're looking for some dissent. We'll talk to Valerie about this a little bit later on. So you saw a big drop in yield stateside yesterday. Today we're seeing a little bit of a pickup back in the States, but here in Europe, that trend lower in terms of the bond market narrative does continue pretty much across the piece as we work our way towards the Fed. There's this kind of sense maybe just creeping in that the Fed's not going to be this kind of easy to digest, easy to understand narrative. You start to get some dissent. Haven't had a lot of dissent for quite some time, certainly not two dissenters. So maybe some volatility around the Fed.
Would constructive ambiguity serve their purposes right now? I wonder.
I wonder as well, but at the moment we're looking at a 10-year about 432 in the States, and we should mention that it's been fairly range-bound. It's been a 420 to 460 range for the last couple of months, really, arguably since Liberation Day, but that range has started to narrow. We're going down to about 430 to 450, and I wonder if we're getting an even tinier range going into the payrolls report on Friday. Of course, all of those expectations are going to show up in terms of interest rate expectations, in terms of net interest income, and ultimately into some of the bank earnings stateside as well. But let's bring back the bank conversation right here to Europe, of course, because one of the big banks we have our eye on here is Santander. I just want to wrap some of the earnings that came out this morning. It looks like their numbers came in line with estimates. We're looking at a net income number of about $3.43 billion versus an estimate of $3.45 billion. So not a beat, not a miss, just right in the middle. You did, however, see some slight weakness when it came to their net interest income as well. That's where you saw a number of about 10.6 billion euros. The estimate there was about 11.2 according to the Bloomberg consensus. They are, however, reinstating their full year guidance and issuing a buyback of about 1.7 billion euros. Let's bring in the man himself, Jose Garcia-Cantera, CFO of Santander, joins us now. Jose, a pleasure to have you on the program. Thank you for your time this morning. Just walk us through these numbers here. You're coming in a little light when it comes to net interest income. What do you attribute that to?
I think overall, the numbers are a little bit better than consensus at the bottom line. We had 13% year-on-year growth in the first half in euros. In constant currency, in local currency, we had 18% higher earnings than last year, with all the lines of the P&L performing very well. We have positive sensitivity to rates, meaning that net interest margins expand when rates are higher. In Europe, we have lower rates, also lower rates in the US, and that's putting a bit of pressure on our NII. However, we are defending the NII very, very well in countries like Spain, Portugal, Poland, the US, where NII performed extremely well in the quarter. And this is thanks to our diversification. We have a well-diversified portfolio of businesses by countries where interest rates are moving in different directions. Interest rates are up in Brazil, and that hurts us because in Brazil we have negative sensitivity to rates. So overall, I would say that the NII performance is actually very good in the context of the interest rate environment that we are facing.
Jose, you mentioned Brazil there. I just want to inform our global audience. Santander is talking about a one-off charge in Brazil to the tune of about 467 million euros. You attributed it to the interest rate sensitivity, but walk us through the tariff impact as well. We're barreling towards that August 1st tariff deadline from the United States. Brazil, Mexico, some of the other South American countries, still very much in the crossfire. How does that affect Santander, who has about 30% revenue exposure to that region of the world?
Well, I think it's very much a relatively minor factor for us. We are a retail and commercial bank. 70% of our profits come from retail and commercial and consumer. And these macro geopolitical tensions tend to affect these businesses a lot less. So we are having some anecdotal evidence that some companies, particularly large companies, are delaying their investment programs. But overall, the macro backdrop remains very, very strong. The IMF just put out its estimates for GDP growth for Brazil, and it's at 2.3%, one of the best performing economies in emerging markets. So overall, I think the uncertainty is coming to an end in some places, like in Europe. So we think having reached an agreement is good because it ends months of uncertainty, and that's good for investment decisions. So I think overall, this is affecting us a lot less than it might affect others.
Okay, can I ask you about, in that context, Jose, where you choose to grow, where you choose to expand the business? You had been talking about growing in the Americas. Mexico and the US have been a focus, I know. And then perhaps some in the market blindsided by the fact that you've then taken on more assets in the UK with the TSB deal. I wonder how you explain adding more in the UK at this point.
I think the UK is a very important country for Santander. We have a very large bank that mostly does mortgages. This is low risk, predictable business in hard currency, in sterling. And this helps stabilize the risk return profile of the group. We have other parts of our business which are higher risk, like we have Brazil or we have Mexico. And having in the UK and having a stronger, bigger presence, larger presence in the UK helps stabilize the risk return profile of the bank through the cycle. And when you look at asset quality, for instance, in the first half, it's doing actually pretty well compared with others. And this is thanks to our diversification. We guided the market for a cost of risk of 115 for 2025, and we are at 114 in the first half. So I think this is one of the strengths of Santander, the fact that we are a retail commercial bank, very well diversified by regions and by businesses.
And so where does that leave you focused when it comes to M&A, Jose? You've said since that deal that there's more money to do deals. What does that picture look like?
Our capital hierarchy is very clear. When you look at the first half results, we are investing the capital on our own business at a return on equity of 22%. And this is why the return on equity for the group is going up. Last year, we had a 15% return on tangible equity. This year, in the first half, is 16, and we are targeting 16.5. And this comes from the fact the increase in the group's return on tangible equity comes from the fact that we're investing the capital on our own business at well over 20%. And that is the key priority. Obviously, we are always open to look at opportunities, bolt-on acquisitions, bolt-on opportunities in the countries where we operate. But to make sense, for us to look at these, they need to make sense strategically. And also, they need to be in line with the returns that we get investing in our own business. So, we are looking, we're going to look, when opportunities come up, but that doesn't mean that we will execute because they need to do better than investing the capital on our own business.
Okay, so good morning, Jose. It's Guy. Does that mean, if you're looking at the United States and you're looking at asset values there, would it be better with an ROTE of 16.5 to build, not buy. Is building better than buying if you can deliver these kinds of numbers internally?
And that is exactly what we're doing in the US. In the US, we are developing our own strategy, our own organic growth strategy based on 3 pillars. One is the retail bank. We launched Open Bank in October, full digital bank. It already has over 5 billion in deposits from 150,000 customers. The second pillar is corporate investment banking. We are executing that very well, and you can see the year-on-year growth. And the third one is auto finance, where, again, in the first half, we are doing a lot better than we were doing last year. So the key objective in the US is organic growth.
Okay, fine. A couple of quick questions. You mentioned auto finance. I just want to ask you a couple of quick car questions. Mercedes-Benz is apparently looking maybe to offload its leasing unit. Would you be interested? Is that a business you've run the numbers on at this point? And the second one is you've got a ruling coming up in the UK relating to the car financing story. What are you expecting there?
Yes, we looked at the Mercedes business and we dropped from the process. With regards to motor finance, the ruling is coming on Friday. We have set aside a provision in the amount of £295 million. For what we know that should be sufficient and more than enough. However, we are going to have the, well, not the final, but at least a very good idea on Friday. So let's wait and see.
Jose, thank you so much. Thank you for joining us. Jose Garcia-Cantera, the Santander CFO. Thank you for being with us. Let's stick with earnings coming through from the banking sector this morning. We had numbers from CaixaBank giving us a new forecast, it would seem, for tangible equity for the full year, saying that should come in above plus 16%. Is that a bit of an upgrade to guidance? Let's talk to Gonzalo Gortazar, the CEO of CaixaBank, who joins us now. Gonzalo, nice to have you on the programme. Lots to talk about when it comes to expansion and growth of the business, no doubt. But just to focus on this guidance line this morning, are you upgrading? Are you trying to upgrade our expectations for what you can deliver in terms of returns for the business? Is that the positive message we should take away here?
Absolutely, Anna. Good morning. Yes, we are indeed upgrading our numbers for this year based on a very strong first half of the year where we have already delivered 18.5% return on tangible equity and where we have very significant growth both in terms of loans and customer funds well above our expectations. And hence, what we are doing is upgrading return on tangible equity expectation for this year, cost of risk, and revenues from fees and insurance. So all in all, a very positive environment for us, definitely.
OK, so upgrading a host of pieces of the guidance jigsaw then, Gonzalo. So with that in mind, what's your strategy for returning cash to shareholders? Some people had been wondering if there might be buybacks here. How are you thinking about the money that you send back to investors?
We love to be generous with our shareholders, both in terms of payout. Up to 60% payout is our policy. We are obviously now announcing an interim or we will be announcing an interim dividend within the range of 30 to 40% of the results for this first half. But overall, full year would be up to 60% payout, 50 to 60%. And then we continue to maintain a policy of buying back shares when our capital exceeds certain limits. At this moment, our target for core equity tier 1 is 12.25%. We have a significant surplus above that number, so you would expect that we will continue to announce when we get all the approvals for the buybacks going forward. So continue to see both growth and general shareholder remuneration being perfectly consistent with a very high profitability.
Gonzalo, sorry, can I just come back? Good morning, it's Guy. Can I just come back to the targets? You've done 18.5 at the half year. You're talking about it being above 16. How far above 16? You're already there in terms of the targets. Can you deliver a number that looks similar to the half year at the full year?
Well, our job obviously is to beat targets and do better than expected. But what you're seeing in the euro area, and particularly in Spain, where we banks have a significant sensitivity to the level of interest rates, is that net interest income is coming down because rates have come down from the 4% area to the 2% area. And obviously that's putting some pressure on returns. What we are doing is offsetting that pressure on margins with significant growth in volumes in particular. So that means that we are obviously defending profitability in absolute numbers, but in terms of return on tangible equity, you should expect it to gradually come down. We're certainly going to try to do as good as we can, and obviously above 16 has no upper limit.
Okay, fine. Gives us an idea of what we're going to be looking at in the second half of the year. Given the numbers you're producing at the moment, Gonzalo, why do you need to do M&A?
It's a very good question, and the answer is we do not need to do M&A. We love the markets in which we operate. Spain and Portugal, I think, are the most attractive markets in Europe at this stage. We have a largest competitive position in the addition of Spain and Portugal, very strong in Spain as well as in Portugal. And we see growth. We have a lot of opportunities, and hence M&A is not part of the picture now.
Gonzalo, it's Kriti in London. Thank you again for your time. I want to expand on that M&A story and maybe take it from a different perspective. You know, in the home country of Spain, there's a lot of question right now about banking consolidation. In your view, is the Spanish banking environment a competitive one? And would consolidation in your sector help or hinder that?
Good morning, Kriti, to you too. The banking environment in Spain is now very competitive. If you look at rates on lending in particular, we have the lowest priced mortgages and SME lending in Europe, close to 1 full percentage points below the German levels and approximately 50 basis points below the average of the Eurozone. So the reality is this is a very competitive market. That means consolidation is about being more efficient, more productive, gaining scale. That's what we did 4 years ago when we integrated Bankia, and it's actually put us in a very strong position now. So I understand that others may be looking at the same option, but it has nothing to do with the nature of the market. Market is very competitive, and it's going to stay very competitive, in my view, given the current dynamics.
Well, given that current dynamics, as you talk about it, you know there's a lot of pushback, not just in Spain, but in Portugal as well, where you operate. Talk to us a little bit about, now that you have not only surpassed your targets, as Guy was mentioning as well, looking to expand beyond Portugal, or would you consider something outside of Iberia or even in other parts of Southern Europe?
There's a lot of talk and some action on cross-border consolidation. We still feel that the right order of things is to have a real banking union, capital markets union, even just a real common market in Europe, which we still do not have. And that will naturally be followed by cross-border banking consolidation. But currently, there are no synergies and lots of complexities in undertaking major cross-border consolidation. So we're very happy to stick to our two, again, very attractive markets in Iberia.
Gonzalo, you're the CEO of one of Europe's biggest banks. We've just seen a tariff deal being done between the United States and the EU. There is some concern in some quarters of Europe that this will be very negative for European growth. What's your take?
Well, it's certainly more negative than the situation we had at the beginning of the year when we didn't have this issue on the table. My sense is that this is a lesser evil, i.e. a no deal and a trade war now with the US is something that the EU cannot afford, not just on an economic basis, but obviously we have other links in terms of technology and notably security with the US. So it is what it is. It's not something that we like to or love, but it's the lesser evil. And I think the lesson here is strategic autonomy. We need to be in a position where 3, 5, 10 years down the road, we're in a position to strike better deals with the US than the current one.
Okay. We'll look forward to that moment. Gonzalo, appreciate the time. Thanks for bringing us the numbers and the analysis around it. Gonzalo Gosizar, the CEO of CaixaBank. Coming up, we'll return to the market story. We'll get a take from Mark Cudmore, leading our Markets Live team. MLIV is the function there if you want to catch up on what's been talked about already this morning. But Mark will be joining us next. That's what the futures picture looks like. This is Bloomberg.
Welcome back. This is the opening trade. It is Wednesday, the 30th of July. Let's talk about the markets in 3 minutes. We're joined by our Markets Live executive editor, Mark Cudmore, with his thoughts. I was looking at European equity market futures, Mark. They don't look all that inspiring, but we've had so much news and we're set to get a lot of data this week. It doesn't feel necessarily as if the market action is living up to all of the inputs. What are you making of the stock market performance right now?
Good morning, Anna. Well, it's precisely because of all those scheduled catalysts that people are reluctant to take too big bets, to add too much risk at the moment. I think ultimately I expect that equities will probably nudge a little bit higher this week. They will survive it. Sometimes the most hyped things are not the major catalysts we expect, precisely because they're so hyped. There's so much coverage spent on whether Michelle Bowman will dissent today for the Fed, but I don't think the Fed really matters. By next week, it'll be forgotten. Ultimately, the Fed's path will be decided by when tariffs, or if they feed through to the real data, and when they feed through, how that impacts the consumer, how that impacts the economy. And it won't really matter whether we get an extra dissent or not this month. So I don't think the Fed is the big driver. I think the bigger driver are probably earnings and data. And what's interesting on the earnings side is the US earnings season's been okay, relatively good. Europe's been a bit more disappointing, a bit more of a mixed picture. That's kind of favoring US stocks to outperform, but neither of them doing terribly. On the data side, what is interesting is that we're seeing consumers still continue to spend. That is the message out of retail sales. That is the message out of GDP data. And very rarely for me, because I normally dismiss GDP data as being too backward looking, I think today's GDP data out of the US really matters, because we're expecting a strong second quarter out of the US to kind of compensate for the weak first quarter that was purely a technical issue because of front loading of tariffs. If we don't get that, that'll really see yields tumble again long before we kind of expect to see, to find out whether Bowman is dissent or not.
Mark, I feel like one of the things that isn't being talked about as much, given some of the trade deals that have come through, are the trade deals that have not come through, like the Brazil, Mexico, Canada, all with a deadline coming on Friday. From an EM FX perspective, which we know you have a rich history in, how do you position for Friday?
You're absolutely right, Kriti, and I think there's still some real negative shocks to come through next week when people register which countries are going to suffer from a much higher rate, haven't got a deal, are being left behind a competitive advantage. I think this goes back to the point that EM is a much more diversified world now. You can't look at in one general scope. There are going to be some real winners and losers over the next month. August is going to be a more volatile month. Maybe not overall really terrible, but definitely volatile and differentiating between countries.
Mark, in 10 seconds, do I buy or sell the dollar if Bowman does descend?
I think the dollar continues to rally from here. It doesn't matter what Bowman does on the descent side. Over the next week or two, it bounces a bit more. Longer term, still dollar depreciation, but doesn't matter for the next couple of weeks. Overall, I think this is the fact is that there's time for a bit of we're due a dollar bounce in the long-term downtrend.
Okay. Little counter-trend rally. Mark, thank you very much indeed. Mark Cudmore, who leads our coverage. He's executive editor of the MLIV team. You can also pick up all of that coverage. You don't have to listen to him. You can do, of course. And there's going to be a video posted shortly. MLIV Go is the function on your Bloomberg terminal. Let's talk a bit about where futures are this morning. We've got a lot to price in. We've got a lot coming up. But at the moment, actually, the equity market is reasonably calm, maybe because of all the news that we have to factor in. The market open is coming. The opening trade is almost upon us. This is Bloomberg. Welcome back. Wednesday morning. These are live pictures coming out of Japan as we continue to monitor what is happening post the big earthquake that we've seen in Russia. Tsunami warnings up and down the west coast of America. We're also seeing those being represented in Japan. At the moment, there doesn't seem to be anything significant. Looks like some sort of aquarium that we're looking at here. And people are certainly looking like they're going about their daily business. So no drama yet coming on that story. In terms of the drama yesterday, well, we did see a little bit of a sell-off over in the United States. You can see that in Europe and over in the United States. This was the fade in Europe. The biggest story, actually, I think, was in the Treasury market. People certainly positioning, maybe getting a little bit more defensive in advance of the Fed, in advance of Meta, Microsoft, and all the corporate earnings that we're seeing at the moment. But I'm not sure there's a particularly good tell coming out of this chart into what we're seeing in terms of the future story this morning. It kind of feels, pretty in some ways, as if the week starts kind of today. The next 3 days are going to be really important.
They are, which is why I think this morning almost feels like a little bit of a nothing burger. And you can see this in the futures picture. Underperformance, marginally, slightly. The FTSE 100 down about 0.1%. But Anna, rescue me. I'm sure the individual stories are more exciting than the index level.
There is so much news flow coming this morning from a host of different sectors, all of which are in focus. So banks, luxury, autos. We're watching all of them. Banks, certainly. We have HSBC underperforming expectations in part because of the performance of BOCOM. And so that certainly weighed on their performance through the Hong Kong session. UBS on the other side of the ledger, though, coming through with numbers that seem better than had been anticipated. On the luxury sector, Hermes seems to be the standout performer to the upside there, or the one that's telling the best story. We had something more disappointing coming out of Kerry. And autos, we're watching Mercedes, but we've also had some guidance from others in the sector as well, Guy.
So does that all net itself out? Do we see, therefore, little movement when it comes to the market open? I think that probably is what we're looking at here. You're not going to see much volatility at an index level, potentially going to see some volatility at a single stock level. And that certainly is the early trade. But we do have a lot of banks reporting out of Spain. That is where we see some losses coming through this morning. So that market is down by around 0.4%. We'll see what Caixa does this morning. We'll see what Santander does this morning. We'll get to the single stocks in just a moment. But at the moment, the stocks 600 absolutely becalmed, as is the FTSE 100, despite what we're seeing with HSBC and names like BAE Systems, which are out with numbers as well. We'll wait and see what the CAC does as well. We're focused very much on the luxury story there. We had Kering last night. We've got Hermes out with numbers as well this morning. We're going to be talking to CapGemini a little bit later on. But no action there, and I suspect we may have to wait a little bit this morning to see exactly how the DAX opens. But the early indications are, at least at an index level, not much to see here, but below the surface, feels like there could be a lot of churn, Kriti.
Quite a bit of churn. I feel like we should just go straight to some of those individual movers that you had named, because interestingly, we're seeing Santander's right now one of your biggest weights on the stock 600, down about 1.5% there. Remember, their earnings came in slightly lower than expected. They came in line, but their net interest income came slightly lower than expected. So some weakness there that the market is not a fan of. Hermes is also underperforming, despite those earnings coming in fairly strong this morning. So that is not necessarily good news for this market. But from a sector perspective, I'm seeing a lot of them. Yesterday's losers kind of be your outperformers today. Novo Nordisk, for example, is your biggest index weight to the upside, which, of course, we know was one of the biggest losers in yesterday's trade. Yeah, it's interesting. It does seem as if the picture we're getting with 2/3 of sectors to the downside, or maybe even 3/4 of sectors to the downside, that looks a little more negative than maybe the futures picture had us believing at the start of today. Financial services, one of the worst performing sectors, and UBS is a feature there, down by 1%. So despite the fact that there were positives in those numbers, that's a weight. But Aberdeen Group is more negative than that. Basic Resources, also a weight on the London market. Rio Tinto, you went through the numbers there, Kriti, and that stock down by 1.4%. So on balance, this is a slightly more negative open, perhaps, than we'd been anticipating. It's interesting. I wonder if Hermes is down because they can't tell us much in terms of the hit. It was really interesting. Some of the companies that are reporting numbers that aren't being specific about what they think the hit is going to be from tariffs are not being rewarded for that ambiguity. And I wonder whether Hermes is basically saying, we don't know yet, is a negative at this point. If you don't know yet, why am I going to invest in you? I can invest in another stock. I can put money to work in companies that do know. Yes, and it seems as if the market, so often we'll say, you know, the numbers backward looking aren't interesting. It's the guidance and the outlook. And that is always and often the case. But Logitech is an interesting case in point because that stock is up by just over 2%. And here's a business that has been telling people it can keep its prices higher. It can push its prices higher as a result of the tariffs. It can counter the tariffs that way. And that story seems to be going down pretty well with markets. And that stock is up this morning on a day where it seems difficult to impress. So is Kering. So Kering is also up this morning. Well, and that was the thing I was saying earlier about how these big drops in sales were actually in line with expectations. Yeah. So I suppose some of that was in the price already, and saying they can cope with the tariffs. Precisely. They've come out and said, we can cope with this. We know, we think we can deal with this. And at this point, we don't actually know whether or not there are going to be carve-outs for this sector. Yeah. It's looking unlikely, judging by what the US commentary is at the moment. But at least they're being reasonably specific in terms of what they are saying. Adidas is getting hit hard, though. Getting hit hard despite, again, positive numbers on the sales front. So that was interesting. Sticking with the German sector, though, Mercedes is flat right now, marginally in the positive territory, higher by, we'll call it 0.1%. I'm being generous. But the fact that it's not taking a bigger hit after those profit warnings is surprising. So, again, to your point, maybe clarity is the trick. Let's get another perspective here. Maximilian Euler, European equity and cross-asset strategy head over at Deutsche Bank Research, joins us from Frankfurt. Max, pleasure to have you on the program. Let's test that theory that we were just discussing with you. Is that the trick to success from European corporate earnings, actually giving a tariff hit or a tariff number in terms of how much money they're going to lose, or how much margin compression, as opposed to not giving any clarity at all? What's the winning formula?
You're completely right. So guidance, first of all, good morning. The winning formula is guidance improvement and also guidance clarity. I completely agree, right? If you look at the stock reactions this earnings season, then you see that any comment on guidance uplift has been rewarded extremely, and guidance cuts, obviously, a lot more down for the equities than any beats or misses on earnings. So the focus is clearly on guidance. And I would say, those companies have had a hard time until Sunday, so maybe they've just not been yet ready to kind of make those statements. But going forward, I think guidance should be improving, because the lower case in that range, of having potentially 20-30% tariffs, which was in the cards just a couple of days ago, that's now gone. So even if you keep your guidance, the top line or the upper end of your guidance the same, you probably have an improvement in the overall guidance, which we think will be supportive for markets overall.
In terms of that supported for markets overall, we're now getting headlines that there may be carve-outs, or at least a push for carve-outs, maybe some questions about whether Europeans can actually deliver on those investment promises that were early on agreed. Does that affect at all the market narrative that is perhaps pricing in now, that 15% level?
Yeah, so we haven't yet seen those investments really. They're still to come. The 15% tariff, we think, is more than priced in and more than reflected in earnings expectations. So earnings expectations have come down since the US presidential elections by 10% for full year expectations in Europe. So massive revisions. And our take is that if we are at such levels, we should be seeing something like a 4% hit to European earnings. So our view is that those negative implications for earnings at a level of 15% are more than priced in. Obviously, then depends on the industry. You've been mentioning some of the auto companies earlier. Here, we think the positive implication should be something like 3 billion for full year 2025, so pretty positive, moving tariffs from 27 to now 15. So that should be pretty positive for the sector. However, that's just one of many troubles that industry has. So if you look at earnings revisions for autos, they've been coming down 50% year to date. So massive hit to earnings. And that's not just because of tariffs, right? There's competition in the US, competition in China, lots of unclarity about the trends in EVs. So that's good news, but it's not enough yet to really push that sector higher, we think.
Max, good morning. So broadly speaking, given that we have some certainty, at least around the tariff rate, even if we're not sure exactly what it applies to, but 15% for Europe and the US, you've been through what impact that does to profitability for European corporates. So do you still feel comfortable leaning into a strong story for European stocks versus, say, US stocks? Or has your thinking changed a bit based on that trade deal?
Yeah, so let's start with the directional upside, and I think the directional case is pretty clear. 2 months ago, we turned neutral, saying there's so many things we don't have clarity on. The beautiful bill, right? By now we have it. We talk about earnings. I think the earnings picture is actually quite good. We've been looking for more clarity in German fiscal. Now we know that the German fiscal is front-loaded, and they'll be spending more than we expected until the end of this decade. So positive. Plus, very big unknown, tariffs, also now known. We know now we have 15%, reducing the uncertainty. Plus, US and Europe, and I'll get to your question in a second, both positive economic surprises, plus favorable financial conditions, and obviously lower tariffs and more certainty on tariffs is good for both regions. So longer term, I'm still wearing my blue hat. I still think mega is the place to be over kind of the next 12 months. Tactically, especially with US tech companies coming out, we think they should be moving in the same directions because they actually have the same drivers right now. And maybe going back a little bit to the question on Germany, we now have clarity, but we don't yet have any spending of the German government of that money. And that will come later this year. So up until we really have that, impulse into order books, I think, there's no reason to believe that Europe is short-term outperforming US equities.
Yeah. And are the positives already in the market for the defence sector, Max? We've had numbers out from BAE this morning raising their guidance. You talked there about the German fiscal spend. Do you think this sector has much further to run? How close to the top are we?
I think we are at the top. If you are a top-down person like I am, right, you were surprised by how much Germany is spending. You were surprised by the NATO announcement now saying 3.5% plus 1.5% on infrastructure, which is almost a tripling of the levels we were at only 5 years ago. So massive impulse. And that is, we think, more than reflected in what happened in the sector. So we have a basket of defense companies that can focus on defense, and their PE moved up from 17 to 37 year to date. So, from a top-down perspective, I'm wondering what's the next news that could really prop those names in that sector up even further. So we think, from a top-down perspective, that story is over for now. We don't see the next big impulse. And what you can do, of course, is look for stocks that particularly benefit from some of the underlying trends. But top-down, I would say the defense story is over for now.
Max, morning. Are you comfortable with multiples where they are right now? 22.5 over in the United States, long-term average 18. You put the S&P on 18 with current trailing EPS, you get somewhere in the kind of 4,000s. Are you comfortable with 22.5? Are you happy to chase a market at 22.5?
Yeah, again, technically, yes. I think that the trends that we currently see, they overrule any multiple discussions. Those multiples that you are mentioning, they are because of what we are seeing in US tech. And if they again manage to deliver earnings growth of 20+%, and we'll know today and tomorrow, then why not let them have that high multiple? So we had multiples starting at similar levels earlier this year. They then dropped because of tech. And they now been moving up and above where we were beginning of the year purely because of tech. And if tech delivers, I think people will not be looking too closely at multiples. In Europe, you don't even have that discussion, right? Because multiples in Europe are still not expensive. And now, I said technically I would be neutral US versus Europe. If you now look further out, I'm still wearing the blue hat because the divergence in PEs is just massive.
But just going back to the tech story, does anything else matter? Is this a market that is purely driven by tech? Do I need to worry about what is happening with tariffs? Do I care about the Fed? Do I care about anything other than big tech? And big tech continuing to drive this AI bus higher and higher and higher. Not sure you drive a bus higher and higher and higher, but let's take the bus higher and higher and higher. Is that all that counts at the moment? Because that is where the multiple story is, as you say.
Yeah, unfortunately, I think today and tomorrow, very little people will be interested in what the Fed is going to do unless they do something very unexpected. And everybody will be looking what the Microsoft, Meta, and tomorrow Apple and Amazon is going to do. So unfortunately, from a macro perspective, that's the new macro variable that we have to be looking at. They are making up the biggest share of S&P earnings. So yes, there's a reason why they're so important, because they're so big. So yes, AI is the driving force. And if you look at performance, again, it's all about tech, right? The rest of the US market is actually not been doing so well over the last couple of months.
Yeah, I think it's planes that go higher and higher. Airbuses, maybe that's where the connection is. Max, nice to see you. Maximilian Julia, European equity and cross-asset strategist, head over at Deutsche Bank Research. Thank you very much indeed. Let's take a look at the core six. This is what we're watching here in Europe. There's a bunch of interesting narratives there. It's interesting to see that LVMH is tracking a little bit higher, but elsewhere we're seeing weakness pretty much across the board. Nestle's fairly flat. That tech trade is fairly flat going into those big numbers. The story yesterday was actually on the right-hand side of the left-hand side of the screen there. Novo took a massive hit yesterday. We haven't really talked about that yet. And what I think is interesting this morning is you are not seeing a bounce on the back of that. In fact, you are continuing to see that trend taking Novo stock a little bit lower after the warning that was delivered. So we're not seeing a bounce in Novo, which I think is worth noting as well. What else are we watching this morning? Let's find out. Chloe Melle's here with the details.
Good morning, Guy. Let's start with consumer goods company Danone, which is up more than 6% this morning. So the sales beat expectations expectations, and there was volume recovery across all of its categories, and especially in the high protein products. So it's benefiting from that protein trend at the moment, and it is up 6% this morning. Moving on to the luxury space. So we have both Kering and Hermes. So Kering is actually up this morning. Its sales were way down, major drop in sales, but crucially they were in line with expectations. So it's getting rewarded this morning. There's kind of enthusiasm about that ongoing turnaround. However, Hermes is down 2.7% this morning. The numbers were really good, but maybe because there is no guidance raised, maybe because there's concern about that exposure to China, to tariffs, it is getting a little bit of a beating this morning, down 3% now. Moving on to Adidas, we've got a similar story to Hermes, where we've got good numbers, but investors are still disappointed. So profit beat expectations for Adidas. However, it did not raise its guidance, and it mentioned that there was still that tariff uncertainty, and that could kind of weigh on consumer demand in the US. So we are down almost 7% this morning. And then finally, JDE Peet's, which is a coffee retailer. We've got a huge increase this morning, up 11%. It raised its outlook, and that's thanks to strong coffee prices.
I thought you were going to say thanks to strong coffee. Well, that's good for this time of the morning. 8:15 here in London. Chloe, thank you very much. Chloe Melly from our equities team. Coming up, we'll be back to some of those earnings stories that we've just been covering for you. UBS, HSBC, Santander, all in focus. We'll dig deeper into today's bank earnings stories next. This is Bloomberg.
Welcome back to the opening trade. We are 18 minutes into the session. As you can see, largely a negative session across much of Europe. Few exceptions. It's a single stock day. It's not a top-down story day. The best performing sector year to date for Europe has by far and away been the banking sector. It has eclipsed everything else, including the defence sector. But what we're watching today is a little bit of an unwind of that trade. We are down by around 0.8% on that sector. There's a number of names that stand out. Some of those names that we've been talking to this morning. HSBC is the big loser, and obviously a big heavyweight in that space. But Santander is down. BBVA is down. Not out with numbers, but you've also got CaixaBank softer as well. So you are seeing some quite significant losses coming through. HSBC is the one that stands out. Thomas Noetzel, our senior UK banking analyst at Bloomberg Intelligence, joins us now to break it all down. I want to start with HSBC. What is the market not liking in these numbers to deliver a near 5% drop?
Well, you have to look into the details of HSBC results. On paper, on the reported numbers, it looks like they miss pre-tax profit. But if you look in the underlying profitability, excluding notable items, it's around 10% beat. So definitely revenue is doing well. Cost restructuring is on target. There was a little bit higher cost of risk because of CRE in Hong Kong, but it wasn't that much to derail the whole profitability. So underlying profitability is quite strong. The bank has confirmed 3 billion share buyback as expected by the market.
That sounds like quite good news.
So, rather good news, but you know what is I think it's all about travel versus arrival, right?
Okay.
The stock has rallied over the past 3 months quite nicely, especially since 2nd April Liberation Day. It recovered more than it has lost. So, you know, analysts are looking, okay, what is the new catalyst, right? And if you look at the stock, you know, it's all in line with the expectation. ROTE, mid-teens, buybacks, same story, but we have still elevated risk, tariff risk, trade risk, right? So there's still some unknowns. So possibly there's some profit taking on stock.
Okay. Let's talk about some of the Spanish banks, shall we, then, Thomas? We've had numbers out from Santander, from CaixaBank. If I start with Santander, that stock down by 2.2%. Seems difficult to impress, perhaps because of the sector having travelled so far.
Exactly the same, I think, story as HSBC. Maybe no, they reported everything in line, met the expectations, met the guidance, no upgrade to guidance despite quite good results. There's no news on share buybacks or higher distribution, which we anticipated maybe because of the recent strategic moves in Poland and the UK. So, you know, we expect a colleague of mine who is covering the stock, like we have to wait till February for new investors' days to have new catalysts that will drive performance of the stock, will help the momentum. So I think it's all about catalyst, everything in line, everything as expected. So we need new catalysts for new momentum.
What about buybacks? I mean, we keep waiting for this era of European banking buybacks to kind of end, either with the volatility or with NII coming down, and it hasn't yet. In fact, it feels like it's going full speed ahead. What is the straw that breaks that camel's back?
Well, first of all, I think it proves that the banking sector is a little bit more resilient than we anticipated to tariff, trade war risk, but definitely interest rate cuts that are coming in the second half of the year will have more pronounced impact in 2026 and 2027. So back then, maybe revenues will be weaker, maybe cost of risk will normalize because we still live in quite benign credit conditions. So we would need to see both those factors to work to have any impact on the share buybacks.
Thomas, thank you very much. A nice little wrap of some of the earnings news we've had from the banking sector in Europe. Thomas Noetzel from Bloomberg Intelligence, thank you for bringing us the banking story. Let's move on to the luxury story this morning. We've also had some corporate reporting there. A pair of luxury brands, in fact, reporting numbers. Hermes sales rising as wealthy shoppers continue to snap up Birkin bags. Meanwhile, Gucci sales plunged as shoppers turned away from Kering's largest brand that's undergoing a design revamp again. Interesting that the share price performance this morning seems to be perhaps at odds with the things I've just described. So let's talk to Andrea Felsted, a Bloomberg opinion columnist, who can help us understand what is happening here. So let's start with Hermes, shall we? These numbers, they looked kind of decent, and yet the stock down by 2.4%. What is it that's disappointed this morning?
I think all of the luxury stocks have been hit by the downturn. We've got China, probably China's not getting any worse. We've also got this phenomenon that tourism is actually down in Europe and in Japan, and Hermes isn't really immune from that. But as Thomas was saying, it's on a very high rating. So if it doesn't beat, then again, there's a bit of disappointment.
Yeah, so easy to disappoint on that particular front.
Yeah.
It is. Talk to us a little bit, though, about where the growth is coming from a lot of these places from a regional perspective. I think we were here last quarter having this conversation with you, and we were talking about this kind of U.S. offsetting China dynamic. It feels like the markets have flipped that this time around.
Well, yes and no, because the phenomenon we've got in the U.S. is that stock markets are really roaring. We've got crypto back. That's historically been very good for luxury. LVMH was saying the U.S. isn't getting much worse. Kering was saying actually the US was a bit stronger for Gucci. China, it's not deteriorating anymore, but it's not getting better. Kering was saying it's really the high-end products that are selling well. I wonder if that's because, wealthier Chinese are more immune. The middle class, that engine of growth, is still feeling a bit under pressure.
What's happening with Sambas at the moment?
Very interesting. My favourite subject.
Okay. So Puma didn't do well the other day.
No.
Adidas, I'm looking at not doing well this morning. What's going on?
So the Sambas really ruled. The Adidas retro styles last couple of years, they've been flying. We're just seeing a broader range of
I'm thinking of buying a pair. That probably tells you that we're coming to the end.
Give him the fashion advice, Andrea.
I'm obsessed with people's feet, and what I'm seeing is a lot more of the Nike retro style. The Onitsuka Tiger, Onitsuka owned by Asics. That's really. I went to the hairdresser on Saturday. Ladies sitting both side of me had those on. Adidas hasn't got the monopoly anymore. We're also seeing Nike coming back. There's a bit more of a move away from lifestyle to performance. Everyone's been wearing trainers for a long time. Now we're getting much more into performance, running, sport. Now I think that's a bit, and that's where Nike's really focusing on. But I think it's a good opportunity for Adidas as well. And the CEO has talked about using the brand heat in the lifestyle sector to move into performance. And what you get with performance, these companies are also fashion brands. So what you get, you want a performance hit, but you want to be able to modify it slightly so it works out of the gym as well.
So which shoe am I buying?
See, Andrea,
you really need
I'm quite a fan. I'm still a Nike girl. I'm quite a fan of those retro Nikes, the low-rise retro Nikes. So that would be my advice.
Okay.
Andrea, I'm going to put you on the spot, 30 seconds if I can. When it comes to the tariffs question around spirits and drinks, how does that affect the likes of LVMH, Pernod Ricard?
Well, LVMH, the luxury group, the handbags, it shouldn't be too much of a problem because, wealthier customers, bigger margins. But having said that, they've all raised prices a lot over the last 5 years, so they have less wiggle room. Spirits, it's gone through the same thing as the luxury brands. Big, overconsumption in the pandemic. that has weakened, so they probably have less pricing power too.
Interesting. Certainly some fallout that we're going to keep an eye on as we see the French still pushing for those carve-outs. Andrea Felstead from Bloomberg Opinion walking us through that earnings picture. Coming up, we stick with more earnings, an exclusive conversation ahead with the CEO of CapGemini as the company announces a multi-year share buyback program. That seems to be the common theme of the earnings this morning. Win or miss? Stick with us. This is Bloomberg. This is the opening trade about 30 minutes into today's session. It doesn't seem like from the surface there's a lot going on, but let me reassure you there absolutely is. I'll give you one case in point when it comes to some of the individual stock performers. Novo Nordisk is one of the big movers underneath the hood, down about 2.4% this morning, which doesn't seem like a massive move for Novo, but add that on to the over 20% drop that we saw yesterday. Of course, it's coming after their profit outlook cut, naming a new CEO, really trying to pull back a lot of the CapEx spend that they've spent on Novo Nordisk. And this is a really big deal, of course, for one of the core six, the granolas, the mega trade, whatever you want to call it, a really big one for Novo Nordisk. And this doesn't even factor in yet any sort of pharma tariff impact.
I think being included in that group was a really tough option for Novo, because since then the stock has been under really quite significant pressure.
Yeah.
We've been on a downtrend. It's facing obviously a lot of generic competition or off-patent competition.
Do you think your core six jinxed it?
I'm going to take full responsibility.
Yeah, it does raise interesting questions, though, about a business that is so geared around, they had other things going on, but it became so geared around one product, and you're so far out in front on that one product, and then everybody comes after you. And what does that do to your business?
I think the real struggle they had, the real problem that they had was that they initially couldn't meet demand. And what that produced was an environment for others to try and step in and meet that demand. And they've struggled to kind of move on from that. And it's still a battle that they're having to fight. Let's turn to another corporate that we're watching carefully this morning. One certainly that is seeing significant upside in terms of its performance. CapGemini, the software company out of France, is up circa 3% right now, just shy of that. Initially, at the get-go this morning, it was up even more than that. So we faded an early 6% move down to a 3% move. But I think we'll take a 3% move on a day when equity markets broadly are drifting sideways, so not a bad performance. At the moment, we're looking at first half results coming in better than anticipated. The top line, the revenue line, certainly driven by some quite nice and improving, it seems, trends. We've got a narrowed outlook from this company as well. Its CEO is Ayman Ezzat, and he joins us now. Ayman, good morning. Can I take the first half and the numbers that you've delivered this morning and extrapolate that into the second half?
Well, for the moment, we see stability in the environment. I think it is good. When you started the year, there's a lot of concern about the impact of tariffs, geopolitics, and the deteriorating overall situation. I think we sailed through the first half with some stability. We still see that stability going into Q3, but we remain cautious for the full year. As you know, there can be very abrupt changes. And although we start to getting some agreements on tariffs, we know there is not an overall overwhelming support for some of these agreements. And we have to be careful to see really what's going to be the impact on the economy, which is still in a slow mode right now. So investment are still pretty tamed from our clients. They don't see a lot of growth in the economy, and that's kind of slowing down the rate of investment. There's some nice deals, but overall it's still not a high growth environment.
So you don't necessarily see the clarity that we're getting on the trade front. And I appreciate that it is back of the kind of napkin, back of the envelope kind of trade deals at the moment. You don't see that clarity being enough to generate a pickup in investment at this stage?
I would like to see it before I can sign on it. We have seen a lot of caution from our client on the investment front for the last several quarters. Yes, there is traction coming from generative AI and agentic AI. It's getting a boost on the other side. We have seen some cuts in other places and quite a bit of control on discretionary spend. That, of course, is holding quite a bit back the growth for the industry overall for the last few quarters.
Ayman, it's Kriti in London. Talk to us about how some of that may be offset by the momentum you're seeing in the AI space specifically. There is an argument here in the markets that all the business uncertainty, all the geopolitical risks that you were seeing around the world can be offset by the idea that AI is growing faster and has more diverse uses than it did, say, even 12 months ago. Is that a trade-off CapGemini sees?
Yeah, so we always have growth areas. I mean, generative AI and AI is one growth areas. You know, we also see, being a large European player, some traction coming from sovereignty, from defense. We see traction in life sciences. On the other side, we have been heavily impacted, for example, by the auto industry. So it's a trade-off between what are the growth levers that we see today, but also some of the negative impact that we're still, experiencing many in the manufacturing industry right now, but also to a certain extent in the consumer goods and retail in Europe.
Well, Eamon, talk to us a little bit more about that growth area as well, specifically when it applies to Europe. There's continued weakness in France as well, specifically in France, but of course in broader Europe. Talk to us about how the AI trade, at least growth picture, works in a place that is still really struggling.
Yeah, so we see, so clients are investing in competitiveness, and we know that generative AI and agentic AI is really a big driver of competitiveness. I think there was a lot of hope about the impact it will have, notably on all the technology costs, IT costs, etc. After 2 years of really working on it, yes, there is some impact, but it's much less than what people expected. It's a lot more complicated to manage existing environment and upgrading existing environment than it is to, for example, generate completely new application or write new code. It's not the same thing, so we don't see. A lot of the hope now is really on the end-to-end business processes. We really see the advent of agentic AI, especially helping us to accelerate the hyper-automate end-to-end business processes, which is really going to drive companies' competitiveness. So it's not just about cost, but it's also about speed of decision-making, quality of decision-making, and also significantly better business outcome. We see it. We see more and more deals coming us that way, and that's really the background of our acquisition that we have done on WNS that we announced a few weeks ago. It's really to go into this new area of intelligent operation where we see a lot of traction, a lot of appetite from our clients, including in Europe and including in France.
Yes, I was interested in that deal with WNS, that purchase of WNS, and the way that takes you into agentic AI, Eamon. Paint a picture, help us understand a little more what difference agentic AI can make to a business. Which are the business processes that will really benefit from the use of these kind of agents?
Yeah, if I try to simplify it, if you take an end-to-end business process, that's probably 4 or 5 steps. You have to break it down to tasks and then to micro tasks. And typically, this end-to-end business process ends up being defined at the micro task level of about 120 micro tasks. And after that, we are able to identify 30, 40, sometimes 50 micro tasks in which you can use Gen AI assistant or agentic AI. And what you do is really hyper-automation of these tasks. It enables you to be able to reduce significantly the length of the process. It's much faster, provide agility, provide scale, but also very good business outcome. If I take a simple example, and it's not just about productivity and cost. They might have 30 or 50 people working on a forecasting and planning process. Through Gen AI and agentic AI, you can significantly improve the quality of that forecast. The quality of the forecast will have an impact on your shipping costs, your inventories, and your fulfillment rate. So you can get significantly great improvement in terms of business outcomes, as I just described them, without necessarily getting a lot of cost reduction. So more and more, what we're pushing is to shift the discussion from purely cost and productivity to really how do you create more value leveraging Gen AI and agentic AI.
And are businesses buying into that, Eamon? Do they want to just save costs, or are they interested in that latter conversation you described?
It's shifting, The people that have tried hard see that it's much more challenging to drive some of this productivity. Yes, there are some areas where we have seen the productivity gain, but the focus on really value creation and business outcome is yielding a lot more results. And that mood is shifting bit by bit towards focusing more around how we can create more value versus just how do we generate productivity.
Eamon, final quick question. The defence spending story has been dominant in Europe since the beginning of the year. We're starting to see Germany beginning to spend money and deliver some quite significant deals. You are downstream of this. Are you starting to see a pickup in the defence business from your defence clients? How long do you think this process lasts for? And just give me a sense of whether or not this is a structural shift, whether this is a long-term narrative that you can work with.
I think it's a long-term narrative. I think it's a complete evolution in terms of the perspective around defense in Europe and the fact that Europe has to take care more and more of its own defense spending and rely less in the US from that perspective. So we do see it trickling down. Not every country for the moment. At Germany, you mentioned Germany. We definitely see some impact there in Germany. And for us, it's both working with ministries of defense, so more on the government side, but also working with a number of industrial manufacturers and industrial players who basically need to scale up their manufacturing, need to invest more in R&D, and hopefully some new large European programs, cross-country programs to be able to develop some new defense armament, where the areas where we play very strongly, like, help to develop, for example, a concept like cloud defense is going to be something important in most of the new armament systems that are going to be developed in Europe.
Eamon, great to catch up. Thanks for the time this morning. Really appreciate you running us through the numbers and the outlook. Eamon Ezzat, the CapGemini CEO. The stock is now up by 2.2%. Earlier on, nearly 7%. So we're fading that early move, but the stock's still positive on a day when we're seeing broadly markets drifting sideways. What are we going to talk about next? President Trump set to make the final call on a US-China trade truce. We'll have the details for you on that story next. This is Bloomberg. Welcome back. More breaking news coming from the corporate story. We've already had Mercedes out with figures this morning. Let's stay in the auto sector and talk about the numbers we're getting from Nissan. Remember that Japan did the trade deal a few days back. A little bit of clarity coming on what exactly is happening there, the car sector being one of the beneficiaries. Nissan is now forecasting 180 billion yen operating loss for the April to September period. Now, that's quite specific, and they're not actually giving us much in terms of the full-year outlook. So no full-year profit forecast. Headwinds include lower sales. I think that probably is something that we already knew about. The foreign exchange story, remember the yen is getting stronger. Therefore, the reported sales coming back into Japan are a little bit more problematic. And the tariff impact that we are going to see. Now, while we have clarity, tariffs obviously on a year-on-year basis are increasing quite significantly. And it is citing a difficulty in forecasting in the current environment. So despite the fact we've got a trade deal, still got a difficult environment to forecast from a Nissan point of view.
Absolutely. Are you going to be in a very different environment in terms of pricing? What kind of volume are you going to be able to shift under those conditions? So a lot of uncertainty there. Let's stick with the tariff theme, though. The US and China are to continue discussing the terms of a tariff truce extension. US Treasury Secretary Scott Bessent says President Trump will make the final call on extending the tariff truce with Beijing.
We don't want to decouple. We just need to de-risk with certain strategic industries, whether it's the rare earths, semiconductors, medicines, and we talked about what we could do together to get into balance within the relationships.
I just had a phone call from Scott Bessent and had a very good meeting with China. And it seems that they're going to brief me tomorrow. We'll either approve it or not. But he felt very good about the meeting. Better than he felt yesterday. Yesterday I said, "Ooh, here we go again. Here we go again." But today it worked out very well.
Let's get some analysis then of what exactly we know and don't know about what's going on between the US and China right now. Our Europe correspondent, Oliver Crick, has been on location in Stockholm to try and ascertain what exactly is happening there. And Ollie, I admit to being slightly confused because the two sides locked in these conversations for quite some time over the last couple of days. The Chinese delegation seems to have said that they've agreed to extend the tariff truce, but America's saying it's too early to say. What are the top lines for you?
Yeah, and you can imagine some of the confusion among journalists who are here all gathered in Stockholm. There were two press briefings in two separate locations, one by the Chinese, one by the Americans, led by Scott Bessent and Jameson Greer, the other by some of the trade delegations from China. And the Chinese went first, and they basically seemed to indicate, as we were awaiting the U.S. delegation, that the truce had been agreed to. They did not specify for how long that truce would go on for, but they seemed to say that, listen, this is locked and loaded, we're ready to go. Then Scott Bessent came out, he said, well, we're not quite there yet. As as we know, Donald Trump does not like to deprive the market of any moments of suspense. And basically, though they had sort of had a very long discussions for 2 days, the U.S. and the Chinese side, and Scott Bessent had actually spoken to Donald Trump, he wanted to wait until the full briefing that will happen today in the White House in order to make a determination as to whether or not to rubber stamp the continuation of that trade truce between the United States and China. And that is a decision that needs to be made before August the 12th, when the trade truce is set to expire. All of that being said, Anna, and I think why the market generally took it fairly positively or didn't take it too negatively, was that all of the sort of sounds from the Chinese side, from the American side, were that these talks were extremely constructive, that they were very, very positive. I would say there was a little bit of detail lacking on any kind of concrete progress on some of the key issues. That being said, they wanted to really cast this as a sort of productive meeting, something that sort of advanced things. But at the end of the day, they wanted to leave the discussion and the final decision to Donald Trump.
Ollie, there's been a lot of chatter about a Trump-Xi summit. Where do we stand on that?
Yeah, I think we're probably some distance away from that summit. I mean, when we think about kind of the discussions that we had between the United States and China, and we tried to sort of drill down on some of the key topics that are still sort of existing between these two sides, we didn't get a whole lot of detail on progress that was made on a number of things. One of our reporters asked the U.S. delegation what the sort of biggest concession that they got out of China was, and they said that basically before there were not magnets flowing, now the magnets are flowing to the United States, and that isn't necessarily a new development. So these are the kinds of things that the Trump administration still needs to make progress on. Outside of that, there is that massive trade surplus that China runs. This is one of the cornerstone promises of the Trump campaign, was to right the trade relationship with China. We are still some distance from that. So I suspect that this is going to be kicking the can down the road. We're going to be in a holding pattern for a little while now. And we should say that we have seen from the Chinese a very large appetite for being tough in negotiations when they ratcheted up the pressure by sending up the tariffs. And we should also say that there is a difference between Trump 1 and Trump 2 in terms of how the Chinese are negotiating. In the first Trump administration, these trade discussions happened in Washington, D.C. They are now happening in Stockholm, Geneva, the United Kingdom. These are places that are seen as sort of third-party neutral places, and that is in part because the Chinese want to assert themselves a little bit more and want to be treated more as equals rather than as a sort of a subsidiary to the United States in their discussions. And we've seen their ability to exert some of their leverage on the U.S. as well.
You wonder where the next meeting will take place, which European capital gets to host. Ollie, great stuff. Thank you very much indeed. Ollie Crook joining us out of Stockholm. We await the briefing later. We await the Trump verdict on what that deal is going to look like and whether or not we are going to see that extension. Let's turn to some of the data. Remember, it's a massive day for data. It's a massive few days for data on both sides of the Atlantic. We have seen some numbers out of France already this morning when we get GDP data out of both Europe and the US later on. But the French economy unexpectedly accelerated in the second quarter. One of the reasons for that is that we've seen an inventory build, which in some ways is kind of forward demand, but this is offset to a certain extent some weak domestic demand and a drag from trade. So net-net, is that a positive? Output rose 0.3, beating economists' expectations for a 0.1. Inventory build, very fickle, very hard to kind of read and call. So Schneeweiss, who leads our Western European economy coverage, joining us now. Anything that you can kind of read out of the French numbers into the wider European numbers, Zoe? What are we looking for there?
So overall, as you mentioned, that inventory build isn't necessarily good news. Obviously, it's good news for the second quarter as such. 0.3% growth is much stronger than anticipated. But overall, it just isn't necessarily a sustainable build. If you do inventories, basically, you're building things that nobody else wants and just putting them in your inventory. Overall, the number for the euro area, economists before those French data had said that there was going to be stagnation in the euro area. That's primarily because German numbers, which we're just about to get, will be in contraction. We also had a contraction in Ireland, which is that wild card in the euro area. Each time Ireland's growth or contraction almost always completely dependent on those big multinationals. So we had the French number. Let's see if that's enough to let the euro area as a whole grow. Spanish numbers yesterday also were slightly better than anticipated. But again, old hand really hinges on Germany.
Okay, so we've seen the French. So what are we expecting then from Germany, Zoe? If that's that's the big one, I guess.
Germany is the big one. We're expecting economists are expecting a contraction of 0.1%. That really is, though, the flip side of that very strong first quarter. If we all remember, companies across Europe, and particularly in Germany, were front-loading in the first quarter. And that front-loading means that if you push it into the first quarter, there's less to do in the second quarter. And that's really this technical effect that happens there. Again, this won't be a contraction in Germany, obviously, is not good news. And we just have a new chancellor here. So obviously a good number in the economy is something you can crow about. Still, a contraction of 0.1% should not be enough to return those calls for the sick man of Europe.
Zoe Schneeweiss, our economics editor in Frankfurt, putting that data into a little bit of context. We thank you so much. Plenty more data, as she mentioned, coming up ahead. 10 a.m. UK time, Euro area second quarter GDP, the U.S. numbers for the GDP as well, plus Bank of Canada's rate decision, all of which may show maybe some signs, maybe some cracks on the tariff front as well. But I think the highlight, the big event of today is going to be the FOMC decision, 7 p.m. UK time, and then earnings coming from Meta and Microsoft. Val's got all of that on her radar. Val, what is top of mind for you?
Oh, the Fed decision. I know widely expected to hold interest rates, but that's really not where the drama is. It's all about whether they start to lay some groundwork for the cuts to resume in the second half of the year. And the way they can do this is by changing some real choice words in the statement. It is the first and second sentence of the statement that characterize both economic activity and the labor market as solid. If either of those are dropped, it could be a hint that the door is opening wider for a September rate cut after their summer pause in meetings. Now, the note, there is something else other than those two lines in the statement to keep an eye on, and that's at the very bottom of the statement where it details the voting activity of the members. We know that Governor Waller set up his dissenting argument essentially before the Fed's blackout period. If he is joined by Governor Bowman, that would be the first time we see two governors dissent at a meeting since 1993. It's more often we get dissents from the regional Fed voters, from the regional Fed presidents, but it's highly rare we get multiple dissents from two Federal Reserve governors. Note, there's only 7 of them, so 2 of them dissenting at one decision could maybe get the market thinking that Powell could have maybe lost some control over the narrative.
I can't believe I'm going to say this, but why do I care about the Fed today? When this is a market that is not driven by the Fed at the moment. It is driven by big tech. The multiples that are being driven in the S&P are by big tech. We get 2 of the big names dropping numbers, and we get 2 big names tomorrow. Today we get Meta and Microsoft. This is all that matters. Forget the Fed, forget trade, forget everything else. It's all down to...
Okay, it's hard for me to get on board with that kind of view, but I will talk to
That's
it.
so
yes.
diplomatic, Valerie.
But yes, we do get 4 Mag 7s reporting in the next 2 days. Meta and Microsoft kick it off tonight. Focus for both of them will be on CapEx spending, whether they raise their CapEx guidance like Alphabet did last year. But then for Meta, it's really all about the justification of this AI spend. They spent $14 billion on the investment of Scale AI. Zuckerberg has spent a lot of money hiring this AI task force, his task force of geniuses.
Every day there's a number. It's kind of we've recruited from here, we've recruited, and the salaries are epic.
$100 million. That sounds kind of nice. Yeah. So it's whether that kind of expense, whether investors can justify it with the current revenue that they're pulling in from digital advertising. So those 2 things will be weighed up, definitely. When it comes to Microsoft, it's about their cloud business, yet again, that's really driven their path higher for sales. I think a lot more focus will be on the sales driven by AI tools. Yeah. Remember, they have that tie-up with OpenAI, ChatGPT. Are they doing well at commercializing the use of AI that could pose maybe some big upsides or downside risk in these results?
Now, I know that AI is obviously now these days a macro theme, but back to your core area of focus, Valerie, perhaps where you spend most of your time in macro land. So we've got data out even before we hear from the Fed. Is that going to be anything that might destabilise our view of the world?
Look, it can be quite interesting because we know that the first quarter GDP was quite warped by the drag forward when it came to the import surge, which dragged on GDP that came into a contraction of 0.5%. Economists are penciling in a 2.6% rise in second quarter GDP, and actually trade is going to be a significant boost to this number today. The most interesting part could come from the more consumer spending angle. We know that consumer spending makes up 2/3 of U.S. GDP. Was Was the front running of tariffs just something one-off, or will that kind of consumer spending be sustained in the second quarter?
Okay, Valerie, thank you very much. Valerie Titel, she has a busy day ahead of her. We have lots of corporate earnings then from the tech sector and all of these macro things to deal with. We will hear from former Fed President Jim Bullard later on today. We'll be joining the Bloomberg team ahead of today's Fed rate decision. You can catch that interview 12:30 p.m. London time. That is it for the opening trade. European stocks a little lower this morning. This is Bloomberg.